Hey, what's going on, everyone? It's Alan here. I hope you guys are all having a wonderful day as always. Today we're going to be going over Jim Cramer's or Mad Money of 3/24, March 24th, which was yesterday, which is Wednesday, March 24th. So this is kind of just a recap of what he went over during his show. Make sure that you guys do go down below. I just dropped a link there for Action Alerts Plus. .com I think is a great subscription. It's definitely worth the value. Definitely check it out there. Where he has a charitable trust, Jim Cramer, and he trades in there and he sends out alerts. Very, very useful. And then also his real money columns, which he posts on every morning. So in terms of yesterday, kind of what was the activity there? The Dow was up, but then it just sunk, barely, 0.01, like 3 points there. S&P was down 0.55%. And the NASDAQ really got crushed. This is on Wednesday, around 2%, 2.01%. So in terms of what he was saying to kind of buy, sell, and hold here, again, same idea. We're still, in that phase where the reopening is kind of booming, and we'll get to that here in a second, right, with this reopening trade portion. But again, focus on cyclicals, right? If you're going to get anything out of this video, make sure, if you have some big winnings, some big gains, especially with SPACs. He was saying today morning on Squawk on the Street, if you're up over 50% on some of these, SPACs, essentially, you would be crazy if you're not taking profits, right? Because it's very volatile and you're most likely going to lose it if you don't take action because of the high supply, which is what we covered yesterday, right? So again, he's saying now consider trimming, tech into profit. Whenever you have a green day on the NASDAQ or whenever you're up on some of these companies, maybe, trim some of those positions and put them still into cyclicals. Again, we're still focusing on banks. Wells Fargo, he said, is a good buy at 36. It is going up to, I think, 38.90 is probably where it closed or so. And then we have industrials. We talked about this 2 days ago. We listed a lot of good industrial companies. Nucor, which came on the show yesterday, was really good. CX was another buy there. It's a $6 company. He was, kind of hesitant, but he said it was a buy there. Adobe actually came on Squawk on the Street earlier this morning, and we'll get there too. I have a little segment here about Adobe. Very, very good quarter, but definitely hold on. Don't buy into now. Why? It's a very good quarter, a very good company, great things, 3 wonderful cloud. They're performing very, very good. They have good guidance for the year too. But we'll get there because, still doesn't matter. If it's tech, it's always going to be wrong. If it's going to be cyclicals, no matter what happens, even if it has a bad quarter or it releases more stock, it still is still going to go up in value. So it's a pretty big deal there. And then the other one was General GIS stock, which is General Mill stock, which would be another, hold there, wait for it. They had that thing with the shrimp. But, they said that they wouldn't have as good, guidance, which we'll get to here compared to 2020 because people want to eat out now. And then again, sell tech into profit, sell your growth, sell SPACs. SPACs are getting overdone. We have a last segment here about SPACs. We'll get there. And then stamps.com was a sell, and same with Frog was also another sell, or just stay away from it, I guess I should say. In terms of the reopening trade, so this was his first segment here. He started off by talking about something FANG versus FANG, right? And obviously we know this term right here. FANG stands for Facebook, Apple, Amazon, Netflix, and Google, which is Alphabet now, right? But FANG is our tech, growth heavy plays. And then FANG, this other one is just the ticker symbol, right? It's the ticker symbol of Diamondback Energy. Diamondback Energy, which is a U.S. oil company that is doing really good right now, and it's doing really well. Hasn't done that great in the past, right? But what's happening is essentially when the price of crude rises, investors reach for FANG, F-A-N-G, the ticker symbol there, or I should just say Diamondback Energy. Oil rises, people look towards Diamondback Energy, and that's what we're seeing right now, right? Oil is going up, inflation scare is going up. Oh, people are putting their money into these boom and bust stocks. One example is FANG, or FANG without the extra A there, FANG being the ticker symbol of Diamondback, right? So everybody's kind of running towards FANG and putting their money into these few cyclical stocks because the price of crude is going up. Right, and currently Jim Cramer notes that the market is dominated by these reopening trades where nobody cares about big tech at all. What's happening is that essentially there's this thing called coined the Wall Street fashion show, right? What Wall Street really cares about right now in the fashion show is only cyclicals, right? There's this big inflation scare, inflation fear that they kind of want to get away from, any consistent growth stocks, any companies, any FANG companies, and they're trying to move over into energy, banks, and things like that, industrial cyclicals, boom and bust stocks. so that way they can really, pursue those gains. So that's what's happening with all these, institutional money managers. They're really focusing on these boom and bust cyclical stocks that will be able to deliver incredible numbers. Right? So Jim Cramer knows that the great reopening trade is not going anywhere. Right? It's here to stay for a while, so make sure you buy into these cyclicals in weakness, right? So he's like, what's a couple names? Well, we have UNP here. That's a good railroad company. Nucor, which comes on later, and then we have MP Materials there, which is also good. About UNP, what he was saying is that it's one of the best reopening players because the railroad is essentially levered to everything that matters once we come out of this pandemic. Right? If Biden wants to have an infrastructure bill, what does that require? Well, that would require, cement, that would require aggregates in order to build the roads, right? If Biden wants clean energy, what does that mean? Well, then UNP will have to move these wind turbines, right? So since they're in the railroad business with the pandemic coming to an end, they have a lot of opportunity, especially with housing boom. Right, they have to make sure they're transporting household appliances, things like roofing, things like lumber. Right, they have also steel for especially non-residential real estate. Oil is coming back, so they have to ship a lot of these barrels of oil. So since they're a railroad company, things are really picking back up. It's really a boom and bust stock. So UNP is really one to focus on there. Right. The next one he got into, I guess, which we'll cover a little later here, with Nucor, which is a steel company that, closed up 2 points for the day, but it was much higher, just kind of sank back down later. We'll come to this company because he talked to the CEO there. And in terms of MP Materials, again, this came on Jim Cramer's show with Mad Money, I think 3 times so far, and it's a rare earth mineral company, which announced essentially a big secondary offering, which made it fall 10% in, yesterday's trading, which is pretty big, and Jim Cramer did tweet to buy the stock. So they are a producer of rare earths, which you need for electric vehicles, which is really, really important. They have been punished enough, is what Jim Cramer says, and the stock won't soar, right back to the highs. I think it was trading around $50. And he did note that there was a lot of insider selling, which wasn't the best thing, but it is still at a good position to start, placing a position into. So UNP, Nucor, and, MP Materials were his names for the cyclicals. That you would buy into weakness here, especially UNP fell as they got that news of Canadian Railroad was merging with Kansas City Southern. But really, Jim Cramer says, go back to the supply and demand thing. It's better going from 4 major railroad companies to now 3. There's fewer of these stocks. Everybody's looking at the boom and bust stocks now, and they're cutting back share. There's a lot of share buyback that's been going on. So very limited supply that everybody's piling their money into, which just creates a really, really good, growth opportunity within these industrial or cyclical stocks, I should say. And then, like I was saying before over here, Adobe did come on Squawk on the Street. So the business is very strong. They have very astounding numbers. They were raising forecasts for the full year, which is very, very important. Jim Cramer just, really focused on, they're just firing on all cylinders possible. They have 3 cloud names, which is doing better than expected, but none of it at all mattered, right? That was the biggest thing. The stock closed down, I think, 8.7, points or dollars. But he says that why, right? The numbers are so good, guidance is so good, the forecast is so good for the year. It's just solely because it's not a reopening, right? It's not one of these cyclicals, and it's just gone out of style again on the Wall Street Fashion Show, right? Wall Street Fashion Show only really cares about, hey, reopenings and cyclicals, not these growth names, these consistent growers, as we've seen during the pandemic. So that's probably the biggest thing. He says it is not safe to buy right here as of now, unless there's a collapse in oil prices where people, or inflation comes down pretty dramatically, or maybe we get another strain of COVID, kind of going back to the pandemic times when oil was negative and everything was very, very cheap then, and all of these things, all of these boom and bust stocks. Well, the economy wasn't strong, so they weren't doing too well, but now things have switched. So he's saying, stay away. There might be a larger pullback still to come, unless you're ready to obviously take the pain. In the long term, these are all good companies, right? And then we have General Mills here. About that, he said they did have a great quarter. However, management did talk the growth won't be as good as, the great reopening. in the Great Reopening, I should say, because people will want to go out more. And then he also talked about Google, which is very, very good way to hedge your bets here. It's a good way to get into your FANG, right? It's a good way to get into those growth stocks again because it's very undervalued is the biggest thing, right? He even said Facebook is very cheap. Amazon, is okay. Apple had some, positive notes that existed. Netflix is doing very good with international business sales. But the main one that he really wanted to point out here was Google, which is fairly cheap along with Facebook here. So it's a good way to hedge and start getting into those growth names. Bottom line is that the market doesn't care about the old FANG, Facebook, Amazon, Apple, Netflix, and Google. They care about the new FANG, right? The reopening or the Diamondback energies, right? In terms of Nucor, just to cover really quick, this is, a breed steelmaker that was up, 2 or 3%, despite, kind of the collapse at the end. We'll leave it at that. So they did have some pretty good projections here for, their full year, projections was that they would earn anywhere from $3 to $3.10, while Wall Street was looking for somewhere around $2.79. So this is the best quarter in the company's history. If they do meet these expectations, it is very cheap. It's trading at only 8 times earnings. So this means it could have, potentially a lot of upside, a lot of room to run. One thing that was important to note is that they do have a lot of order entry, like their order entry rate, I should say, is very strong. And their customers themselves are doing very well, which is a positive note. They are expecting to see much better results than quarter one, which is also good. And then non-residential, construction, automotive, and housing are all obviously booming right now. So that's resulting in better than average demand because it is one of those boom and bust stocks, right? So economy is doing good, Nucor is doing good because it's a steel company at the end of the day. So one thing is that the CEO does know that, hey, we are a cyclical company, right? We have these boom and bust essentially. So when they're having, booms, they have to make smart decisions and make the right decisions to essentially add capability to make sure that in the next 10 years, they're doing what their customers will want at that time, right? So they're trying to essentially plan ahead so that way they'll be set up during that time for what the customers want. But since they're this boom and bust company, they only do well when the economy is strong. They have to make sure they're well positioning themselves and, investing at the correct times so that way they can effectively keep up with their consumer demand. So that's one of the big things. All of these sectors are doing very, very well now with the economy reopening. So they're really taking advantage of that, which is super huge. And then, so that's the investment side. In terms of an infrastructure bill that they're trying to pass, this will, Nucor will be a primary beneficiary of this. It will be huge for Nucor because Nucor has so much to do with steel and, building infrastructure. So obviously they're going to be the first ones that are going to benefit from the infrastructure bill. At the end, Jim Cramer does say it can only go higher here if you are a believer. So still a good stock. Again, the main thing is that it is at 8 times earnings, so heavily discounted stock that has a lot of room to run because we only really care about the reopenings in this market, right? So that's the biggest thing. Then he went on to Gamestop here, just to cover Gamestop. It was the first earnings since the 450 mark when it hit the top, high 450 after that short squeeze back in the end of January. He said they did everything right? He said, what was really, they had some really, impressive numbers. They were making smart moves. The business was doing very well, but what do we know? Stock fell 34%, right? So it just got hit really hard. So they are in a tough position, because, the past explosion, right? The short squeeze. You can't really, beat a short squeeze. You can never expect to see numbers that high again unless we have another short squeeze that will bring it up, right? So nothing the company said would have been a positive catalyst, right? Because already they had such good numbers, which we'll get to here, but that didn't even move the stock up. It instead, cut in third, right? In a third. So what was management doing? Well, they're remaining pretty quiet, right? And Jim Cramer says that makes sense. Why does that make sense? Well, they don't want to risk losing their shareholder base, right? Because if they say something that, is not that bullish in the eyes of the Wall Street bets crowd, what would that mean? These guys are now running out, right? These guys are running out and their stock price drops, so they don't have that much they can do with their capital and effectively make investments over the long term. Right, but we did see good news that they are de-densifying by closing, I think, around 693 unprofitable stores, and they were cutting costs, which is very, very beneficial over the long term. So in terms of some of the numbers, same-store sales were up 6.5%. E-commerce sales grew by a whopping 175%, which is just amazing. And this accounted for a third of their total there. But Jim Cramer says, do wait for 8. He said if he was between $15 and $20, he would be a heavy buyer, but not when it's in the triple digits, to definitely hold off and wait on that. For his no-huddle offense, what he said is that he went on to this backlash, or the SPAC out, essentially, that's going on. We know that there's been 292 SPACs listed in these 3 months, 3 months that exist here. Over $93 billion has been raised. And what we have to realize is that, yeah, there are good, there are bad SPACs, okay? And there are also good, and there's bad operators that exist, right? Regardless of what's happening, is that the bad SPACs, the bad operators, are essentially leading to the SPAC out. They're bringing all the good SPACs down with it, right? And this has been something that's been going on. So he says, if you are going, with some of these SPACs, be very, very selective, right? We have a SPAC out in place. There are bad SPACs. There are bad operators that are kind of bringing down these better SPACs. So be very, very selective in the stocks that you are going for, right? And finally, what do we know? The markets can just, as we've seen, we can have a SPAC out situation very, very easily, right? We have reached SPAC, essentially saturation. We have reached like the maximal flux point, where, people who are starting SPACs now are just way too late to the game, right? So the market will be fine, Jim Cramer says, without, even during the SPAC out situation, I should say. But any SPACs that are coming in now, trying to do reverse mergers and things like that, they're just too late to the game, and they're really trying to pick up just really not much right now, because the focus has turned to, cyclicals, to these boom and bust companies. Right, so that was kind of summary of his March 24th, or, Wednesday's Mad Money. I hope you guys all enjoyed. Make sure to go down below and drop a like if you did enjoy. Subscribe to my channel if you're new. Turn on post notifications so that way you're aware when I do upload my next video. Comment down below. Till next time. Peace.